Hey guys, welcome back. Very happy to have Joshua Saul of Pure Gold, based out of the UK, but delivering to just about anywhere. He'll tell you the one or two places he doesn't deliver in a minute. But one of the real value of having contact with someone like Joshua is he's sitting with his finger on the pulse in terms of the supply and the demand. And he shared an article with me before we jump in maybe into the belly of the beast story about the Bank of England and pensions. You shared an article, Josh, pointing to a 400% increase in demand on physical gold. Why don't we start right there? Because that's pretty much right on the button, isn't it?
It's a good place to start, Francis, and thank you very much for having me back on the show. Um, I would say gold demand within the entire market, not just for us at the moment, is almost out of control. Um, we've got a team that specializes in sourcing physical metal, including gold and silver, and then we've got a team that sells it. And it's almost become a contest to see, can we find enough metal to service demand? And I'll come back to you in terms of who's winning that contest in a minute. Um, the figures increased from when I sent you that note a week ago. Over the last 7 days, we've seen a 490% increase in people purchasing physical gold coins and bars compared to the weekly average over the last year. And we've had a whole host of economic crises continue to pile up. Whether or not we look at the cost of living crisis, which includes, not just the cost of debt, but it includes the cost of energy, that was then met with a mini budget induced currency slump that was then reversed with an amended mini budget um, announcement, which then resulted in, I guess, the market having very little faith for a government that they already had very little faith in. Um,
They
we've had,
managed to low ball the low ball.
sorry,
They managed to undershoot an already low bar.
I know. I mean, I've over the last, I would say, 6 or 7 years, I've kind of resigned myself never to be surprised in these really unpredictable markets, and I believe that I continue to fail myself with every crisis that we see, and with every announcement. I believe we wake up on a Monday morning fearing that is this today is will this be the day that the next prime minister is replaced? Just because we never know. And I think we can see it evidenced in the value of the pound and the rapid decrease in the value of it. Um,
Yeah.
Property market fears, interest rates have increased and are increasing. It's not so much the what we've seen to be the increase, but it's what we
What's
fear
still to come?
rates have to be increased to in order to put us to a point where we're at parity with inflation. The stock market volatility, all of these factors that we see are driving many people to safe haven assets. The most notable trend, Francis, at the moment, I would say, is the 319% increase in investment bankers that have been purchasing gold and silver. And their main reported concern here is counterparty risk. Often the case, it's not what they tell me that's concerning. It's what they refuse to comment on. Now, we've all been watching with bated breath about the rising demand and cost for CFDs. Um, and right now, they're indicating that there's a 23% chance of default for Credit Suisse and a 17% default for Deutsche Bank.
Yeah.
But those are the knowns. What about the unknowns? And I think because we're looking at inflation, which I think right now is around 8%, if we take into account that They don't include, a variety of other things that they should include within that metric, such as, house prices. We're not going to change that during this conversation. But if we assume that it's 8%, but we also take into account that Goldman Sachs predict it may well hit 22% by next year, the general sentiment is of, the cost of doing nothing right now is too high, because to leave your money in a bank earning, a considerable, a considerable discount to inflation against a backdrop of escalating counterparty risk is I guess a situation that clients don't want to find themselves in. So they're looking at alternatives. They're
Yeah.
looking at, should they put their money into property? Should they put their money into equities? What about bonds? What about gilts? Should they leave money in the bank?
None of
And
the
it's
above.
well, that's that. In a way, I agree with you. I still believe that through process of elimination, people still need to continue asking themselves that question, because sometimes there's a great opportunity to put money into the property market, and I would say that actually we're probably about a year away from from realizing some great opportunities. During every recession there is an opportunity to normalize the value of capital assets and for us to take advantage of them. We're probably about a year away, but I think, by asking ourselves by asking ourselves to assess the alternative assets out there, right now what we end up seeing is people being diverted back to physical tangible assets that are capable of being liquidated quickly. Our clients, they're worried about not being able to keep up with the rising cost of their mortgage. As interest rates increase, in addition to energy and food bills, the collapse of the pound is weighing on our clients. We've got a lot of clients that work within the hospitality sector. They work within, their restaurateurs, their retailers. We've got everyday clients that, they've got stalls. They're greengrocers. And the concern there is a lot of the food that they sell, is a lot, the increase in that cost is much higher than the reported amount for inflation. Energy bills, we've got a client of ours that have two restaurants in central London. They're reasonable sized restaurants, and they're concerned that their utility bills are going to be in excess of around £600,000. So, and that doesn't even go into their cost of debt. And the concern is, are we up against the rising cost of energy? Are we up against the rising cost of debt? Are we up against the fact that people demand for the goods and services that we supply? Will they decrease to the point where we're not able to service those costs? And in an answer, we kind of need a recession, don't we? We kind of need a washout.
Yeah.
Over 21% of inquiries over the last 7 days, Francis, have come from people who plan to use the proceeds of property sales to fund further investment in gold and silver. They're looking to sell in the next few months to avoid interest rates of 5 or 6% in the next year or two, which they've categorically said they won't be able to afford. And I think it's important because inflation doesn't take into account the cost of our it doesn't take into account our mortgage. It doesn't take into account the value of property increasing. The inflation, which is the rise in cost of commodities and services, they're saying could top 22% by next year. I think it was Goldman Sachs that made that prediction. Whether or not they're right or wrong is a completely different conversation. People
Is that
believe
even
that.
possible? Because
I
if it
can't.
were to happen, if it were to happen and you were going to go deep into double digits like that, into the 20s, where do interest rates need to be? Because they're already behind the curve. You're at 2.25. America's at 3.25. Currencies believe go where you treated best, flows out of the pound into the dollar. You already have precarious debt. You have, along with the EU, probably the worst, all the EU states, worse than Sweden, Norway, uh, Denmark, in terms of most assessments, in terms of viability of indebtedness to GDP. We're lagging. The UK is lagging too much. And I would actually argue, as much as Kwasi Kwarteng got thrown under the bus a bit there, and he made a mistake, clearly he misread the sensitivity. Why has the Bank of England been doing 0.5 interest basis points hikes when America's been doing 75? How did they let them get a percent ahead when you know that the international capital flight will take place? If you're a hedge fund manager or global treasury corporate in London, you're going to have dollars. You're not going to hold pounds. You're going to earn more. The difference to the inflation CPI was higher in the UK at 10.1, and you had the US at 8.6. Yet you're lagging the rates. This is actually a central bank error as much as it's anything else, apart from the additional little. I mean, the guy only got given the job a month ago. The pound was at 142 in May 21. It's fallen a long way. He just added to the pace of the final capitulation for this next technical rally.
Yeah.
I don't see any let off for it, Josh. I mean, this is not just for UK people, but it's particularly for UK people. If you are not getting physically held assets right now, if you are relying on digitized wealth, you're in big trouble. And property could go lower. I think it could be more than a year away. I think this thing goes on harder and longer. People enter too soon. I mean, I love your opinion, and I like to check my own opinion. I'm just maybe too dystopian, but the debt is failing. There's no bid. There is no bid for the debt markets. The Bank of England is the buyer of the last resort. Toxic bank has arrived, and it's the central bank. And pension funds are actually selling off to meet margin calls on to pay existing pensions. Never mind those commitments that are down the road if you're 55 and you only start to draw at 65, just to deal with the people now. And you've got to pay into a system that's probably not going to be good for it. That's going to turn into some quasi UBI central bank digital token nightmare. If I was in Britain, I would cancel all further contributions to pension funds and I would start stacking
I mean,
silver
if
and
the
gold
market
and
could set the
admit I was
price of
wrong.
money, I would say that if the market, it's the market. If the market could set the price of money, you could bet your bottom dollar that interest rates would have risen a lot higher and a lot quicker. And I agree with you. I think there is a massive drawback in the fact that it hasn't increased as quickly as our US counterparts, because I believe that all we're doing really is kicking the can down the street.
Well, at double digits, you're at 10.1. I don't know what the number will be this month or when it was last, whether maybe there's a month ago, maybe it was September's number I'm talking about. But to have 2.25, let's say it's even 9 or 8.5, and it's come down with a bit of a recessionary effect. You're 6% destroying money. You're compounding a minus 6.25% here.
Yeah.
It's unsustainable. It's a death trap. You can't hold debt. And the debt markets are so big, and the pension system in the UK, having worked and lived there for so long, everybody has a smoothed with profits with Standard Life, Norwich Union, I don't know if they call them that anymore, et cetera, all the usual players, Equitable, etc. These guys are dumping. They are having to raise cash. We're going to have a default, surely. Surely
Yeah.
it's not. I mean, without us having to be purveyors of doom porn, is it not time to start thinking quite realistically about the fact that this is wholesale default and that a new system has to come out of this and that they're going to renegotiate the contract of welfare, pension, the whole lot? This is your on-ramp UBI central bank digital token. The people should be clearing you out. You shouldn't even be able to show up and say, Francis, I don't even want to generate any new demand. I can't fulfill what I have. I'm
Yeah.
shocked we're not there yet.
I think the way that I see it is, look, there are a lot of casualties and victims during a recession, but at the same time, the silver lining is that a recession can end the misallocation of investment capital. And whether or not that's fueled by a housing bubble or a dot-com bubble or a debt
Yeah.
bubble, by driving down those asset prices, recessions can also provide opportunities for attractive returns for
Yes,
those investors
you're right.
willing to take the longer view. And I think, if we look at if we look at the recession during the 80s,
Mm.
which was triggered by the Federal Reserve interest rate increase in response to high inflation, it helped reduce inflation from 11% down to 5% in 1982. This was in the US. The US economy then grew for another 8 years after that. So I believe, in a way, the quicker we can get to that kind of cleanse, as it were, the quicker we can start to grow again. But
Yeah.
I agree. I think everything right now is massively, massively overvalued. And if we talk about the literal definition of inflation, which is the rising cost of commodities and services, by definition, physical gold is a hedge, right? It's a hedge against that rising cost of good, as it tends to increase with all of the other goods and services. But at the same time, it serves to provide stability as a safe haven asset when markets are uncertain. They're unpredictable and volatile, as they are at the moment. If we look at inflation, whether or not we agree it's 8% or 9% or 10%, gold this year is up 18%. And most would say that it should have increased far more than it has, given all of the other conspiring factors that support the gold price increasing. And I would say that if, let's say, the gold price increases by 10%, and we've got inflation that's 10%, I wouldn't say that gold has gone up by 10%. I would say that the value of our currency has decreased to the point where it takes that much more currency to buy the same ounce of gold. And I
Yeah.
think right now the goal isn't so much growth, it's about being able to maintain purchasing power to take advantage of
Yeah.
all of these other opportunities that might present themselves, after the recession, whether or not they are cheaper properties or cheaper equities or better bonds. There will be those opportunities. But if you're not able to maintain wealth up until that point, then it's a moot point. So, what does one do whilst they're riding out the storm? And I can tell you, we've never seen demand as it is right now. Obviously we've lived through Brexit and we've lived through COVID, two kind of black swan events that we could have never predicted. And we weren't ready for demand at that particular point. Demand now is higher than it was back then. Availability of UK gold coins is extremely, extremely low. And the timing of it all couldn't have come at a worse time. We had the passing of the Queen. This sparked a surge in demand for not just UK gold coins, but gold in general.
Yeah.
And the Royal Mint decided to stop production, and therefore there has been no new coins within the market. All of the older coins have been snapped up. And going back to how we started our conversation in terms of, are we able to get enough metal to sell? The answer is some days no, we're not. Um, we're almost entering into the realms of the watch market or the timber market or the plasterboard market, during COVID, where there just wasn't enough supply. You can the value of a watch on the retail market may well be £7,000, but all of a sudden the value of these watches were being sold for £20,000 or £25,000 because you just couldn't get them.
Mm.
And what we're looking at right now is overwhelming demand, little to no supply, not a huge amount of guidance from the Royal Mint as to when supply will pick up. And let's not forget, the Royal Mint are already on the back foot because of COVID and
Yeah.
the production issues then. So they're already trying to catch up with the fall in supply from then. The fact that they've literally turned off the minting machines for the last 3 weeks has further compounded that. And the mint there is capacity. Various mints and mining plants around the world, they can only mint or mine a certain amount of gold per day. They can't go beyond that. And right
Yeah.
now, we're at a point where demand is already considerably higher than supply, and will be for some time now. And not only does that support people purchasing physical gold, because gold tends to protect you in times of uncertainty when people have very little faith in commonly held assets like equities or property or bonds. But at the same time, you're purchasing something physical, and when you're purchasing something physical, there is a premium, and people are able to almost take advantage of an arbitrage in premium, because the premiums that people are paying or receiving when they sell their gold today are more than they were 6 months ago or a year ago. So there are situations where the gold price may well remain flat and people are able to make money purely because of an increase in the amount of the premium, if that makes sense.
Which just proves the lie in the paper market's price. I mean, it's almost a casino token for betting on, that's been manipulated by derivative players rather than actual physical demand. It's a guide, but what you're saying is premiums are extending. That means a coin in your hand physically held, the premiums are extending. The price is going up higher than the paper price, which makes the paper price really just a weak proxy, an a lower beated proxy actually in these crazy times. It's fascinating. You also said a few other things in your opening gambit. You said it's it's what the bankers. You've had a massive increase in clientele, particularly those coming out of the financial services industry. And you also made the comment, which is very, very close to one of my favorite sayings, is that it's what they're not prepared to comment on that's almost as telling as what they are. Meaning it's almost like it's not true until it's been officially denied, or in this case, refused to be responded on. That tells us everything we probably need to know. I'm expecting that the guys must be shaking their heads and saying, we don't survive this. You refer in recession, and I suppose the difference in our opinion, we're broadly on the same boat and aligned. The difference in our opinion is I think this is a once in an entire macro cycle. While in some ways you're still talking as if we're just going to have another recession like 80s and 70s, I just think it's too big, it's gone too far, and it's a reset the clock. And we know there's other forces that want to bring in a new game. And I think it's the one to end all others. I think it's the full clearing of the site. The building gets bulldozed. It's a controlled demolition right the way down to the ground. You're not refurbing and doing a decoration and a freshen up and a new lick of paint. This is flatten the site, start again. And I think, if anything, I'm over making your case that you're understating in some ways, which is typically British and a good thing. But allow me to come in over the top maybe and say it's going to be a bigger fire this time. It's going to burn everything, and you're going to start right at ground floor level again, and it'll be a substantial problem and a reaction. I think that there's going to be a turmoil interim phase that is outlived other kind of recessions and resets, because so many things are contingent on each other that will fail. If British pension systems fail, that's literally the global system gone, because that's correlated, and the other side of it is the bank. One borrows really long and pays out little bits frequently, the other borrows short and does. Basically, that's the banking system gone. That's the debt market. We've borrowed money into existence. If the debt is going to zero, that's somebody's liability that's disappearing, but it's also somebody else's asset that's disappearing. Ergo, the pension funds, which have been kind of the dumb money buying into the cycle. 2 years ago, we said that this is top bond. market long before anybody else, and that rates would have to climb and that debt would devalue. The problem is there's no orderly devaluation of this debt because everybody suddenly comes to the same conclusion at the same time that people have been saying for decades. There's too much of it about. It's been paying too low a rate. So no one wants to be a buyer. So the central bank is left as last buyer. So what does he do? He creates currency, which is proliferation, to support a Ponzi scheme that actually has no bid. And he's holding it up. He's being Atlas holding up the world. The central bank thinks he's Atlas holding up the world and doing us a favor. Meanwhile, everybody is seizing the final window to get out. The cinema's on fire and they've smashed the doors open. They're herring out faster than they can. They can't hand over devaluing negative 6%, 6.25% compounding. That's without Goldman Sachs's future inflation rate taken into account. How broad does it get if they get anywhere close to 22%? Does that differentiate? You could have minus double digits compounding against you in terms of value retention. Pensions won't be able to sell their bonds and they won't be able to make payments. The only upside is the interest rate will go up on something that's fast vanishing. So that's the collapse of money. So we go into a complete disinflationary, almost deflationary, complete contraction. And that means people will start bottom buying gold property too soon, in the same way that the bottom buyers of crypto are still too soon and haven't seen the macro. That's my view, but I maybe I'm a doomsday artist. I don't know. I just think there's too much out there. But tell us about what have you been told from the financial guys? Because I'm always curious. I'm totally uncorporate. I'm not in the investment banking. Never have been. No buds to phone up and say who's squeaking about what. What are the guys whispering about? What are they prepared to say?
So as you know, we at the Pure Gold Company, we offer a curated consultative service to anyone that wants it. High net worth, low net worth, investment bankers, accountants, and lawyers. We're one of the only firms that actually offer a consultative approach opposed to a transactional website. The benefit to our clients and our customers is that they get real kind of up-to-date, to-the-minute guidance on when to buy, when not to buy, what they should look at, what they should avoid. And to receive that proper guidance allows them to avoid some of the things that, results in them being unstuck. For us, we get kind of colorful qualitative data. So yes, we have the stats that, many other companies that would have in our situation. But what we have that most others don't is the emotional underlying motivations that drive people to do what they were doing, to drive people to do what they are doing. And actually, I was having a conversation with someone that I know about a week ago, and he was telling me he's a broker. He works in the city, and he was telling me that it was 24 hours before they had announced the Bank of England kind of bailing out the pension funds. And he was telling me that as long as the instruction for him from his clients is as long as it traded, sell it. It didn't matter for what price. It didn't matter when. The margin recalls were coming in thick and fast. And you're completely right. Our system is underpinned by pensions, and if they were to go, then the end would come far closer. It would come far sooner than it currently is. I think when you talk, a lot of what you say makes sense to me. A lot of what you say, I can see happening. I think at the end of the day, it's confidence that we need. It's confidence that we don't have, and it's confidence that I don't feel is even warranted for at least a couple of years. Our clients, they're not purchasing gold, or the majority of them aren't purchasing physical gold to become millionaires. It's not about making money. Don't get me wrong. If you look at gold over the last kind of 20 years, you can see that it's outperformed pretty much every single market. I think it's, over the last 15 years, it's up around 500% in various different currencies. But the real reason that our clients are doing this, especially at the moment, is for safety, for security
Yeah.
and for wealth preservation in an asset class that has intrinsic value, in an asset class that has a store of wealth, but a track record in something that has increased during every single recession or depression that we've ever been exposed to.
Yeah.
At the same time, if we are in a situation whereby, clients have, experienced what we saw between 2007 and 2013, where we've seen a 300% increase in the gold price, um, physical gold in the form of UK gold coins removes any sort of an obligation to pay tax. So it's completely tax free. So in a way, it works in exactly the same way as an ISA does. The difference between an ISA and physical gold is an ISA has various restrictions. You can only
Yeah.
put a certain amount into an ISA. An ISA has a
Yeah.
counterparty, that being the bank that you're entrusting. With physical gold, you could put in as much as the market is able to sell you. Um,
Yeah.
and there is no cap in terms of what that might be from a theoretical point of view, and therefore any gain that you make is completely tax free. As I said
Take a
before,
breath there. Take a breath there, Josh, because just for people that are not from the UK, I'll explain an ISA. It stands for Individual Savings Account. It's a bit like a 401k in America. There's quite a few differences, but for Americans, it's the closest thing that are watching this. But you're limited in how much you can put away in there. And then the cause celebre is the wrapper is around it. It's in a tax-free bubble. So once you've already paid tax on your income, if you then take some after-tax income and you dedicate it to, or unless it's taken, sorry, there's a certain allowance that's pre-tax, is it, Josh? I've forgotten now. It's been a while in the UK, but I think the time I was there, it was around £7,500. Can't be too much more. Maybe it's a sub 20 today. I'm sure you can put about 10, 12
I
grand.
think it's just under 12,000, which is the annual
12,000.
allowance.
Yeah. So that can compound without having any end of year tax repercussions on the basis that it's like a personal savings vehicle for retirement. But you can't, if you start dipping into it, there's certain rules and regs, how much you can put in, etc. So it's like a limited 401k that has a very small amount that you can put annually. £12,000 in truth. If you have 10, 15 years left of working in you, it's simply not a lot of money because you probably get in a year, if you put 10 grand a year, you get 120,000. And in the inflation rates we're talking about, it's something, but it's not a great deal. So that's what an ISA is, and Josh is just highlighting an ISA there. So thanks. Sorry for that sidebar. Carry on.
No worries, no worries. I think we're sitting right bang in the middle of history. I
Mm.
believe that in years to come, they're going to be teaching, they're going to be using current day status quo to explain
Case study
economic.
material.
It,
You're,
it,
you're,
it,
you're finishing my sentences, Josh. I've been saying this for 10 years. The fact of what's going on right here from all this quantitative easing, the synchronization, the mega boom and bust cycles, this is the case that they'll look back on and say the folly of man. I actually now think it's been far more engineered than anything else. I think that's the plan, but only at a very, very high level. Everyone else it falls under the umbrella of the folly of man. It's going to be a case study, exactly what you say, of foolhardy.
I guess in so many ways, from a psychological or a social experiment, as to how we have endured so many different events, from Brexit to kind of enduring 4 or 5 different prime ministers over the space of 4 years, to COVID, to huge currency debasement, to inflation. And I remember when I was younger, and my grandpa would tell me that an ounce of gold back in the 80s would cost around $25 to $30.
Yeah,
And to fathom that now, based on the fact that right now an ounce is just under, call it $1,700, you know, the value of gold has certainly exceeded any inflation that we've seen from the 80s. But many people are saying that when we look at the ounce price of gold today, call it $1,700, there are very many predictions right now that support 5,000 or 10,000 pounds per ounce in the next kind of 5 to 10 years. It might seem crazy to think that that might be the case, but then if I was to go back to the 1980s and say the same thing about today, we would probably say the same thing about the value of gold right now. The fundamentals that support gold increasing are far stronger now than was the case back in the 1980s, because debt relative to income is so much higher now than it ever was back in the 1980s.
Yeah.
And therefore, I believe that the interest rates increasing to 5 or 6% is far more damaging than interest rates increasing to 17% back in the 90s, because the reliance on debt was nowhere near as close to the
100%.
reliance on debt current day.
Oh, absolutely. In fact, talking of debt, I want to bring this chart in. I'm not sure if you can see this, Josh. Let me know if it's showing up.
Yeah.
Am I sharing screen? Nothing at the moment. Let me minimize that. Can you see this chart over here that I've annotated a bit?
Yes.
This was the US debt 10-year bill, and this is the UK 10-year bill. The candle is the UK, and the orange line is the US. And in actual fact, debt payments were 0.101 down here on the UK 10-year. UK government bonds, a gilt 10-year, 0.01. And at the same time on America, it was about 0.5. So quite a bit more. And the red box is showing the difference. And you can see that actually expanded a bit when the treasury debt started to accelerate in its loss of value, the yield going up and the value going down. And then we moved, and then the roundabout here, you can see this, the inflation going through all its various narratives. It's not there, it's not serious, it's transitory. Okay, it's hanging around more than we thought. Okay, it's serious problem, we need to start raising rates. The whole central banking tip-tap-toe game that they played with us. Roundabout here, July, British yield started to accelerate significantly faster than American. And I've just had to adjust this purple box for today because I'm going to drop it to a lower time frame. The orange line is the American debt there. The British debt is sitting at 4.5 on a 10-year. And this is going to lead to continued loss of value in bonds, which is going to require greater sell-off of that core capital holding that they have. And it's going to lead to a cascading diminishment of the asset base that's actually generating yield because it's shrinking and they have to sell more of it off to pay their current pensions. So this was the 0% that you are barely above, not more than September of 2020, in and around there. 2021, as we turn into 2021, you're at 0.18, and today you're at 4.5%, 0.18, 0.18, 0.19, call it if you're for a rounding error, and 4.5 today. This is a parabola, and you don't stop that snowball halfway down the mountain. It's going to smash the village, and it's going to get bigger as it goes. That's part of its process. That's my take. And the concern is it's dollar dominance over the pound, because you're seeing a lesser acceleration, although also going up, on the US side, because their central bank, the Fed, has reacted more aggressively. And they're passing the pain of debt collapse onto everyone else and exporting that inflation as well, because everything dollar cost, they keep the dollar strong. It's less inflation for local population and more damage to rest of the world, which continues to see a feeding on itself deval in the pound and the euro, and particularly the Asians, which get spoken a lot more. I mean, a lot of us know people in Britain and in the Euroland, but the Asians are actually far worse. We just get less information out of it. But if you have a look at this just on a shorter time frame, and I'll just take the American out of that, this is typically what we'd call continuation. This was a small pullback that we had here. And I'll just draw some lines. That was a little falling wedge once you've made your 4%, which was a key level. And bang, you had your little pullback after there, and now you're back up, and it's almost ready to run the previous high. And that's going to keep driving the deval of debt, which is the loss of value in the currency because the money's borrowed into existence. And that's what so many people can't. They say, well, the pound's had a rally now from 103 up to 111, 113, whatever it is. Let's pull up the British pound
But it's not
for
a
everybody.
rally. It's recovered somewhat based on the back of a decision that was reversed. But I
Correct.
wonder
It's
as
a
well,
technical.
I wonder what the correlation is between the interest yields, the devaluation of currency, and then the demand for credit default swaps.
Very high. I imagine people are buying default swaps like never before. By the way, this is also a head and shoulders for us in a particular HVF kind of way, which means for British folk and Euroland and yen and rest of the world currencies. What's happening here for British clients isn't like, this isn't, oh, you're sitting and you're safe. You're absolutely facing the same game. And America just falls last. So even for the Americans, for now, you get to be the stick that beats the rest of the world currencies up and fail. But their failure is your eventual failure because of the relationship of the banks. That's a left shoulder upside HVF that was on the long side going up where the pound was recovering. It tapped out at sub 115. And this head and shoulder sees you going back below 108 and you're trading 110. It's a broadening structure over there. This is very bearish and you're skidding into marginally lower lows. It wouldn't surprise me you have another event-driven collapse. And I see not only parity falling, but much more. We've been sitting here calling 0.8s potentially being challenged to the downside below that on the euro. We've said on the Swiss franc 0.69, and we've been saying this for 2 years, and it's happening. And the pound was to be affected by this as well because it's a dollar strength phenomenon. And for all those anywhere in the rest of the world and eventually America, but if we're talking particularly the British right now, your currency is about to be killed further, and it will surpass the low here in due course. Hear me now. We've done this with the Euro Swiss franc, the Euro USD, the Japanese yen, and the Korean won. All those trades are substantially in profit. We've got the right copybook for this playbook, and we're making money on the trading markets and turning it into physical metals. This is resetonomics. Guys need to come on board. You need reliable, honest, show their face bullion dealers such as Josh who will deliver to you. And anyone I speak or interview, I have used personally. And Josh, I'll be putting in a further order with you, by the way, as well, in due course, to bring both forms of metals over, physically held. Do not keep it in a bank vault, friends. Make better arrangements at home. It's safer there, in spite of burglaries. And keep quiet. Don't talk about what you're doing. But this is terrible. This is the pound going to skid lower as well, and this is going to just cause more demand. Eventually, Josh might not be able to meet the demand. The bit of the news before I let you respond to that. Pension fund panic led to Bank of England's emergency intervention. This was a systemic failure. This was a Northern Rock event that was actually a pension-based Northern Rock event. Essentially, people were queuing outside needing their pension paying, and the pension had run out of cash and had to drop bonds on the market to sell, as you described. Doesn't matter, any bid, just get us out, turn it into cash. Josh said that. People were saying, hit the stack, anybody bids, hit it. There was no bid. The Bank of England had to come on in eventually and be the bid for an unwanted, over-proliferated Ponzi-onomics of debt. Now, how badly do you want digits of debt that might pay you some pension that's highly bankrupt or something physical that's always felt like real money in your hand and that will still be there tomorrow? And you said something else that was really powerful as well. It's almost not so much about the gold and the deval of everything else, the proliferation. I've always said gold is a 40,000 foot parachuter plane. Call it a Dakota if you want to go old school. And all the currencies are jumpers that have jumped out of it. And they can look up at the plane and saying gold's going higher, when actually gold's holding value and doing what it's always done. It'll still be there. It won't rust. It won't fade. It won't rot. It'll still be precious, unique, and difficult to find and expensive to extract. And those currencies that are all falling and measuring themselves, how far the fat one's falling relative to the thin one, that is the real game. You're in a downdraft collapsing. Time to get some of the aeroplane and less of the fiat that's heading to the earth at a very rapid rate.
They say, a certain percentage of your wealth in physical gold goes a long way. One hopes that their gold doesn't go up in value because, it going up in value indicates the fact that the other 90% or the other 80% of their portfolio is decreasing. But physical gold is an insurance policy. It's similar to credit default swaps. Back in 2008, I don't know if you ever saw that film, The Big Short,
Yes.
where no one believed there was going to be a collapse, and because of it, they were able to buy credit default swaps for next to nothing because no one believed that there was a risk worth protecting. And I think the difference between then and now is people I was having a conversation with a journalist the other day, and I won't name who it was. They contacted us for comment on what we're seeing and why, and they were saying that what really grinds their gears is the amount of government officials that turn around and say no one could have predicted this. It's beyond
Yeah.
anyone's control, and
Black Swan.
exactly, it just came out of nowhere. The fact that we've seen kind of a huge increase in the value of these credit default swaps, effectively it's an insurance policy. So banks and financial institutions are buying insurance policies to guard them against the possible collapse of other debt, other bonds, other investments. Physical gold does exactly the same thing. The difference between physical gold and a CDS, a credit default swap, is that some would say that if everything collapses, would the person that has issued the credit default swap even be able to pay out? Right?
That's the
Whether or
problem
not
I
that
have.
happens or not is a big question. But with physical gold, you have got something that is intrinsic, right? It's not going to set your world on fire. You're not going to wake up in the morning, it's going to be twice the value it was when you went to sleep, but it will be there. And it has an intrinsic value, and it doesn't sit on anyone else's balance sheet. There's no counterparty risk. It increases with uncertainty. It's a hedge not just against inflation, but against currency devaluation. And that's why you'll see that people in the UK have probably done better than people in the US. That being said, the dollar right now is far too strong. It's higher than it deserves to be. And therefore, if a US national wanted to protect themselves against the prospect of a falling dollar, gold would be a very good asset to do that. Because not only is it guarding against currency, it's guarding against inflation, it's guarding against the fallen value of equities, the fallen value of property. But what's really important is that you can liquidate really quickly. If you want to take advantage of seamlessly other opportunities, be it property or in the equity market, or you just need money, our clients can liquidate within minutes and have funds back in their account. That's really important. Because
Although I'd caution against that. I'd say your physical metal held, even if vaulted with yourselves or held at home, is safer than bank accounts now. The problem, as you mentioned, is the scale of everything is so vast that counterparty risk means nothing is safe that is digital. Any digital bank, any pension, any contractual obligation. We're talking about paper and things stored in the computer, the ether. It is actually a great irony is that in crypto we got this major development, AI and metaverse, and it's the virtualization of everything. Own a piece of la la land in the ether, etc. Virtual goggles, talk to your friends, bots and mates from all over the place. And never before, as this is being pursued on one front, and it is coming. I'm not saying it ain't going to come. It's absolutely coming. Never before have you ever wanted to be more the opposite and go completely physical, de-hook from excessive TV, internet, and virtualization, and ultra, serendipitous sort of, what do they call it when you watch somebody else's experience, voyeurism, and all of these tendencies. Go back to just getting your stuff in order and get it physical and get it where you hold it and control it and protect it. Because all state-based things, and I think bank vaults, and even official vaults, they could just get the armored car over there and grab the clipboard and say, this is being held. You want to hold it yourself, and Pure Gold are the guys that will deliver it to you. Where don't you deliver, Josh? Because you go anywhere. Can Americans get from you?
Oh, absolutely. So we deliver everywhere other than various countries where it's very, very difficult to transport to. Countries like India, Nigeria, the Middle East. Those are countries and regions
Oh.
that are very, very problematic for us to get metal to. But everywhere else, we're open
Would that
to.
include Australia, which is far away? Would you do Australia? Because I got to ask
Australia,
that question.
absolutely, absolutely, yes.
Australia,
Um,
US. So the Commonwealth, if we talk about English language nations, which are being an English channel, Canada, America, if you're English speaker in Panama, Brazil, Latin America, largely good. A DHL will come in there. All of Europe, just not India, Middle East, parts of Africa, Central Africa. Could a South African get?
yes, I believe they would struggle to get metal into the country. That's the only issue. So we do have a lot of South African clients, and a lot of them like to purchase, store within our bonded vault. We store with Loomis International, where everything is fully insured. They get a full audit of everything that's being held for them, and that might be a short or a long-term um, measure. So some of our clients decide to store it until they can come to the UK and retrieve it themselves. Some of
Yeah.
our clients like to store it longer term, and other clients like to take delivery in the UK, put it into a safety deposit box that they control, so they can access it whenever they want to.
Yeah. Okay, excellent. So that's a whole bunch of people. The big numbers that you heard today, 490% up. And what period is that in demand? Is that by cash
400,
value?
it's a 490% increase in the value, the overall value over the last 9 days in people
Wow.
purchasing physical gold. And as I was saying before, when we see a trend of around of a 319% increase in investment bankers purchasing gold, we don't need to ask them why they're doing it or what for or why not next week. The mere trend itself gives us more than we need to know. So if we can convey some of that to some of our clients that aren't necessarily privy to that sort of information, it provides us with a lot of insight.
Yeah. So to summarize from this interview, because we must let you go, uh, it's scarier to the bankers than you realize. You're probably not hearing it all. Things are probably far more advanced than you realize. They are absolutely barnstorming in to secure physical metals. Demand is up 490 for the layman. That's almost 6 times. 500% is 6 times in a course of 9 days over normal averages. You've been going for quite some time. You'll know your averages pretty well, Josh. You can be delivered virtually anywhere apart from those few exception nations. And if you don't own it and hold it, counterparty risk is probably the biggest I've ever seen it in my lifetime. In short, I expect wholesale. I'm even on winning trades in broker accounts, bleeding off profits. I don't want to run them too lean in case of market moves, but bleeding off profits and converting into physical on account that brokers can fail if they're banking and counterparty. It all will come back to a banking system that is all sharing the same exposure as the pension system, and not a falling dominoes. It's a magic circle where it's almost like a scrum where everyone binds on each other. If the hooker goes down, the scrum and the front row goes down. And that's it. It's a full reset. They even call it resetting the scrum. So that's my analogy. The scrum is about to get reset. Get in there before the punches are flying there in the flankers and the hookers, and ensure you get your goal. Any parting shots, Josh, and also a reminder for how guys find you so that we can finish?
I would say, look, we can't control the world's problems. We're not going to control debt. We're not going to control whether or not the equity market falls or increases, whether or not property falls. All we can do, the only control we have is of our own finances and our own wealth. And I
Yeah.
would say that if we can get to a point whereby we can realize and take advantage of the opportunities that will no doubt present themselves in 1, 2, 3 years' time, um, we will prosper. But the point is, we need to preserve wealth up until that point. And the tried and tested way of being able to do that is by using something that our parents and our great grandparents and our great grandparents before them used to secure their wealth during times of uncertainty: physical gold.
Yeah.
And I
To
would say
Marco
that
Polo and beyond, world trade, gold and silver
absolutely.
coins.
And it's just about removing your wealth from the banking system. That may well be short term, it might be longer term, but the autonomy and the control is completely yours as to when you buy it and when you sell it. You can find us by following the link in the comment section. You can contact us at thepuregoldcompany.co.uk. You can book an appointment with one of our consultants who can explain to you the market, how to get started, when to get started, what to avoid. And if you're not ready to get started, that's absolutely fine. There's no pressure to do so. But having a conversation so that you can do so with information, I think, is absolutely paramount.
That was brilliant. And you triggered me on one question I forgot to ask that I meant to. I've purchased platinum through you as well. So not only is this gold, the name is pure gold, but I've bought mainly silver, bought some gold, I bought platinum from you. In fact, inside of that, Josh, before we let you go, is there any over demands and under demands, anything special that you see across the precious metals complex? What's your gold versus silver allocations? Is it the bankers mainly going for gold because they've got big mounds? What's the blend? What's the mix?
I would say that we are probably 75% in favor of gold. Um, but
By value?
sorry,
By
by
value, pound
value.
pound.
I predict a big change over the next 6 months because, excuse me, silver's massively undervalued. And whenever we see an increase in the value of gold, we see a bigger amplified increase in the silver price. Um,
There's also the talk of a short squeeze at the moment. I mean, do you have a comment on that as well?
I would say there's a short squeeze in all metals,
Yeah,
as opposed to just silver. We're seeing it
just a
across the
degree.
board. Yeah,
Yeah,
we're seeing it in gold, we're seeing it in silver, we're seeing it in platinum. Um, and if you look back to 2008 in dollar terms, we saw the gold price double from the bottom. We saw the silver price increase by more than 5 times. So there are
yeah.
many analysts out there that predict that the silver price will jump to around $50 again. Um, and now's probably a good time to take advantage, just because silver can be a lot more speculative than gold. But if we
Yeah.
know that gold is increasing and we know that silver has an amplified
Response.
relationship to that of gold, then it pays more to take some of your allocation in a little bit of silver, because it takes it takes a smaller amount to result in a larger monetary gain.
Is the industrial element of platinum the thing that's kept it down? Because it's been kept down ridiculously long. It's actually rare to that over decades that it's this much cheaper than gold. It is actually far rarer to find as a metal, and itself has very, very unique properties. Is it just the industrial element? If for people that are asking the question, should I have some platinum? What would you say? Is it going to give you a kind of a blend of the gold and silver? It's going to probably go up if gold goes up, but could have a bit more of the beta of silver on the upside, possibly. Is that a fair comment?
I would say it's a fair comment. I would caution against the fact that with platinum the spreads are wider because the retail market available to buy and sell platinum is not as big as gold or silver, and
Yeah,
therefore it's not as liquid.
yeah,
You're right. Silver, platinum, heavily manipulated by various institutions. some of which begin with a J, and then go on to P. I would say that there is, inflation will push up the cost of getting these metals out of the ground, and there's no kind of avoiding it. Inflation is the rising cost of commodities. So as I
Yeah,
said before, by definition, by holding some of those commodities, if you're holding it, you're hedged. If you're not holding it, then you're on the other side of it.
absolutely. That's a fantastic comment. Really enjoyed this today, Josh. I appreciate your time and your comments and sharing your intel. I encourage everybody to make use of the link below. It is Pure Gold. Is it .co.uk or .com?
.co.uk.
.co.uk, but servicing virtually globally with very few exceptions, delivery to your door of metals of your choice with a consultative chat with one of his experts and enablers and onboarding team. Josh, thanks so much. Really appreciate you coming on, and it's been great chatting, and thanks for sharing some of that intel.
Thank you very much.
Have a good one. Bye-bye.
You too. Goodbye.